Hello everyone, this is Richard, CEO of altFINS. In this video I will explain the volatility over the weekend, why did USDC and DAI stablecoins depeg over the weekend, and also I'll explain why the Silicon Valley Bank went bust within a few days. So it was a turbulent week for sure. Let's take a look at the performance when we go to this crypto screener section. On the performance tab right here, we can see the performance of major coins over the last day, week, month, and so on. Over the last week, Bitcoin is flat. Ethereum is actually in a slight positive, and some of the other larger altcoins are mostly in single-digit declines. Now, that really doesn't tell the full story. Let's take a look at the graph, or the chart for Ethereum and Bitcoin. As you can see, let's get rid of some of these lines here. Let's just focus on the price. As you can see, the price over the last few days took a big step down here all the way to the 200-day moving average and then bounced back up in the last couple of days. It's interesting to note that the 200-day moving average has held up, which is very important for any hope for the uptrend to resume. So that's bullish. And that really looks very similar for Bitcoin as well. Let's take a look at here. Again, also dipped down to 200-day moving average and then bounced back up in the last 2 days. So what happened? First of all, I'll note that you can read some of these comments in our weekly macro review report, which is under the Research Hub section. And here we highlight some of the major events that took over the last week, and also what's coming up in terms of macro data points that may be impacting the crypto markets, and there always are, right? And as you can see, here's the weekly performance. While Ethereum and Bitcoin are mostly flat, a lot of the other major altcoins in the top 25 market cap are down single digits, some actually in double digits as well. Now, what happened over the weekend or last week? When we go back to the performance and look at the chart of the stablecoins, first of all, so stablecoins, the major stablecoins are Tether, that's been around for a long time. It's still the number one stablecoin. Number two stablecoin, USDC, and then we've got Binance USD, and then DAI, right, based on the market cap in this column here. Well, let's take a look at USDC chart, and immediately what jumps out is this drawdown here. The low of this candle, which was on Saturday, is 87 cents. So this stablecoin that should be holding its value 1-to-1 to dollar obviously did not. It depegged. It dipped as low as 87 cents, and now it's mostly regained its peg with the dollar, but not entirely. But it looks like the crisis has been averted for now. But clearly what it really should be doing is what's doing most of the time, which is plus or minus very close to $1. So what happened on Saturday? I mean, clearly, why did it beg? Well, clearly there were a lot more sellers than buyers. And it shows that traders who had money in these stablecoins, and let's take a look at DAI as well. It looks very similar. Also, big dip here. In fact, some more volatility even today, but it's mostly now back to almost entirely to the dollar peg. So what happened with these two stablecoins? I mean, clearly it shows that traders who had money in these stablecoins were trying to sell and convert them into other stablecoins like USDT, or into other crypto like Bitcoin and Ethereum, which those two actually traded up over the weekend, as a lot of the traders actually used Bitcoin and Ethereum as their go-to cryptocurrencies while they were getting out as USDC and getting out of DAI. Now, USDC is operated by a company called Circle, which is based in the US. And what it does is simple. It helps institutional investors onboard into crypto. So institutions like hedge funds, family funds, and so on, those who want to buy cryptocurrencies, first they have to deposit fiat currency like USD, US dollar, and exchange that into crypto. Just like retail investors, first we have to convert our fiat into crypto. Well, Circle does that for institutional investors and traders. It takes US dollars from institutions and then issues USDC stablecoin with a 1-to-1 ratio. And now when the institutions have the USDC, now they can go and buy Bitcoin, Ethereum, and anything else. And when they want to pull their money back out, they hand or withdraw USDC, and Circle then gives them back the USD deposit, 1-to-1. Well, that ratio of 1-to-1 got disrupted over the weekend, clearly, because traders were worried about Circle's reserves. See, Circle keeps the fiat money it collects from institutions in traditional banks. It uses many banks, and one of them is Silicon Valley Bank. In fact, about 3.3 billion of the 40 billion that it has in reserves, or 8% of USDC reserves, were deposited into Silicon Valley Bank. So when Silicon Valley Bank got into hot waters, traders got worried that if Circle loses 3.3 billion of the USDC reserves, it would get crushed by withdrawals, and some institutional investors or retail investors would be left with holding an empty bag, right? With holding nothing but useless USDC worth zero. Kind of like what happened to the Terra Luna stablecoin, TUSD, if you recall, that was crushed in the spring of last year. Now let's cover, why did Silicon Valley Bank get into trouble? Well, Silicon Valley Bank's been around over 40 years and has really established itself as the bank for tech startups. In fact, nearly 50% of US venture-backed companies were customers of Silicon Valley Bank. We're talking thousands of tech startups, mostly US tech startups, that raised capital from venture capital firms or funds, VCs, and deposited that raised capital with Silicon Valley Bank. And one of these companies that use Silicon Valley Bank, as I mentioned, is Circle, the issuer of USDC. Now, things were going great for Silicon Valley Bank when tech startups were raising boatloads of capital. I had no problem raising more in 2020 and 2021, but that changed last year in 2022. VC funding has been declining, as indicated in this chart here, and this is the investor relations presentation by Silicon Valley Bank itself. This is their fourth quarter 2022 presentation. And as you can see, US VC-backed investment activity, so funding of tech startups in terms of billions of dollars raised, clearly ramped up in 2021, but has been on a very fast decline in 2022. Now, that also means that these tech startups that usually operate at a massive loss, they need to dip into their deposits to pay for their operating expenses. So as startups were able to raise less capital, they are now forced to gradually withdraw more money from Silicon Valley Bank because they got to cover the salaries for their employees, the investments into research and development, into marketing, whatever it is. They're burning their cash, and so they're withdrawing their money from the Silicon Valley Bank. Now, usually that's not a problem because you're just able to raise more money in the subsequent rounds. But when the VCs stop funding these unprofitable tech startups, cash flow becomes a problem for the tech startups. So they're starting to withdraw more money from Silicon Valley Bank, and you can see that in the chart on the bottom here, with the pink columns in the minus are outflows or cash burn for tech startups, while fundraising, public or public, dark blue and light blue, clearly were on the uptrend in 2021, but majorly contracted in 2022 as well. And so more is outflowing than inflowing for these tech startups, so they're withdrawing their money from Silicon Valley Bank. Now, if Silicon Valley Bank kept all of their clients' money in cash, that would be no problem. There would be no problem with these withdrawals, right? But banks never keep clients' deposits in cash. In fact, they only keep small portion of the deposits in cash. They invest most of that cash into loans, into other fixed income securities like treasuries and bonds. So let's take a look at what Silicon Valley Bank did with their clients' money. As I said, only 7% is in cash, the green piece of the pie. 55% is invested in fixed income securities, U.S. Treasury, bonds, bills, and so on. They also provide loans to clients. And these are also very illiquid, so you can't just call on the loan and say, pay us back at any time. And then there's some non-marketable securities and others, right? So most of it is not in cash. And when we take a look at what's invested in fixed income securities, here's a breakdown of some of those. Majority of those are in RMBs, real estate, mortgage-backed securities, shopping malls, and so on, offices, other commercial mortgage obligations, right? But the point is that as clients, these tech startups are withdrawing money, Silicon Valley Bank doesn't have all that money in cash. They have to sell some of these investments. However, what happened in 2022 is that the Fed has been increasing interest rates, which means that the value of these fixed income securities like bonds has declined since the bank has invested in them. So there are unrealized losses on these investments that the bank has made. And if they are forced to sell these investments, then they are realizing basically these losses. And that creates liquidity issues. So what then really snowballed issues for Silicon Valley Bank was that on the March 8th or 8th of March, they put out this update for the investors and investment analysts in their community saying, hey, we are going to raise some capital to shore up our balance sheet. That they have sold substantially all of their available for sale securities. These are the most liquid investments. And also that they are raising $2.2 billion additional capital via the sale of their own stock. And that spooks their clients, the startups. It creates the impression, and a correct one, that Silicon Valley Bank is in trouble. And in fact, some VCs tell their tech startups to withdraw their money from Silicon Valley Bank. And that creates even more fear and accelerates the withdrawals of deposits from tech startups. And that creates basically a bank run. And within a couple of days, the bank is really in trouble. The FDIC, or Federal Deposit Insurance Corporation, steps in and announces that it backs the bank's deposits with guarantees, which means that at least the startups will get their money back, although the bank investors and bondholders will not. But at least the tech startups, including Circle, the backer of USDC, should have access to the $3.3 billion that they have deposited with Silicon Valley Bank. And that has now helped the stablecoins regain their, mostly regain their peg to dollar almost entirely for USDC. So crisis averted, but that's really what happened. And what does that mean for crypto traders? I think with the volatility that we're seeing, both on the macro level and to some extent crypto-specific events, we need to hedge our bets. So traders who own cryptocurrencies also have some short positions. Ideally, for example, with our chart patterns, you can find situations that are bullish and buy signals, or bearish and sell signals, and ideally a trader has both. And that way, when a major market event happens, you're gonna hedge your long positions with some of the short positions that you have on your book in your portfolio. Now we'll demonstrate this strategy in our next video under the education section right here, crypto education section. So stay tuned, and we'll be posting a video on how to run a hedged portfolio. Thank you, and I hope this is helpful. If you have any feedback or recommendations, please email us at invest@altfins.com.